Another way that ratio analysis can be used to evaluate a portion of a company's financial position is to check the ability of your company to pay off your long-term debt. And for this, we have three ratios: the debt ratio, the debt to equity ratio, and the times interest earned ratio. The debt ratio is a measure of how much of the total value of your assets you don't actually own because it's still being financed with debt. So you would go to your balance sheet and you would find your total liabilities and your total assets. And if you divide your total liabilities by your total assets and convert it to a percentage, you figure out what portion of your assets are still being financed by money that you borrowed from somebody else. Think about it like taking out a car loan. Whatever portion of the value of that car you still owe on is your debt ratio on that car. So for us right here, for Smart Touch Learning, we see that in 2026 they had $431,000 worth of liabilities against $787,000 in assets. That's 54.8% of their assets still being financed by a liability, by money that they owe to somebody else, which means that we really only actually own less than half of our assets, the complement of that, which is like 45.2%. We have a higher debt ratio than we did last year, but both of these are still well below the industry average. One thing that I've noticed in my time teaching this class is that it's the general perception that having a bunch of debt is a terrible thing. And while that's probably true for your everyday person, just normal civilian living in the United States, you definitely don't want to have debts of 80% of what you own, etc. For companies, it's pretty common of the way that they operate. Most companies will have a debt ratio well over 50%. In our industry, that average looks about 69%, which means comparative to somebody else, we still have room to finance some more. If we need to acquire even more assets, new equipment, develop some patents, etc., we can take out loans to finance those activities and still be below the industry average in debt ratio. What about the debt to equity ratio? It's a measure of how you proportion out your financing between the portion that comes from liabilities versus the portion that comes from equity. And it's on the balance sheet. You would take your total liabilities and divide it by your total equity. Smart Touch this year has $431,000 of liabilities and $356,000 of equity. That's a debt to equity ratio of 1.21, which means their liabilities are 1.21 times their equity, or another way to look at it is they have $1.21 in liabilities for every dollar of equity that the company has. In 2025, running those same numbers, liabilities divided by equity would come out to 1.01, which means we are increasing the portion of our financing model that comes from debt. Typically, to ask what is a good balance number for this, it really just depends on the industry that you operate in. One seems to be the pretty good spot that people want to be around. They want to have a pretty equal balance between liabilities and equity. But apparently that's not the case in Smart Touch Learning's sector of business because their industry average that they're going against is 2.23. So just like the ratio that we had before, the debt ratio, our debt is lower than our competitors in comparison. And once you have debt, you have to pay for it. So your other ratio is the times interest earned ratio. While that debt's outstanding, you're going to have to make payments. There are definitely loans that businesses get where they pay interest and only interest until the end of the loan's life, and then they repay the entirety of principal. So here we're trying to figure out how well we're able to pay our interest based upon what we're making. And the formula for this is to take your net income and add back in your income tax expense and your interest expense. Why would you have to do that? That is because interest is tax deductible. And to figure out what you actually have to work with to pay your interest, you would have to go to the point before you paid your interest. So for us, we would take our $64,000 of income, add back in our income tax expense, and add back in our interest expense. Give us that total on the top. I think the total is up to $105,000. And then divide it by your interest expense, $24,000. That comes out to 4.38. And what does that mean? That means at the time that we had to pay interest, we had enough income to do so 4.38 times. You want, in this case, for the sake of safety of being able to pay your interest payments, You want this number to be as high as humanly possible. So we are quite happy that it increased from 4.07 to 4.38, but we're nowhere near the industry average. So while the industry appears to be taking on a lot more debt than what we're taking on, it also appears that they're much more capable of financing it from the income that they generate from their normal course of operations. So that is a ratio, when put in contrast with the other two ratios, that would cause a little bit of concern. Earlier I said we have the ability to take on more debt. Well, now looking at this ratio that's part of that whole general aspect of our business, that might not be the case. So yes, we have the ability to take on more debt and keep our ratios below the industry average for debt ratio and debt to equity ratio, but we don't have nearly the ability to pay for it. So maybe before we consider taking on loans to expand our company, we might want to find some kind of way to convert more of our revenue into net income so we can finance the payment of those interest payments in the future. Speaking of increasing your profitability, there are several different ratios that you can have to evaluate your profitability. The profit margin ratio, the rate of return on total assets, the asset turnover ratio, the rate of return on equity, namely common stockholders' equity, and the big one for this section, EPS, earnings per share. So the profit margin ratio is just a measure of how much of your sales revenue you convert to net income. We talked about this when we were doing a vertical analysis of our income statement, and we already know that for Smart Touch they had $64,000 of net income against $858,000 of sales revenue. That is 7.5%. So we're converting 7.5% of our sales into income. Much better than last year. And hey, look at this, way higher than the industry average. Which is curious, because we were just talking about how we don't have enough net income to finance stuff. So this, in comparison to that last ratio I had, is telling me that we do a pretty good job of converting our sales revenue into income, and we just don't have dollar amount enough net income. We need to scale the size of the business, and maybe if we do have more assets to work with, maybe we can generate more net income. Speaking of assets, what's your rate of return on total assets? This is a measure, in simpler terms than what's written here, of how well your company generates income based on what you have to work with. A company that only has a couple of machines operating out of one location probably is not going to have the ability to make as much income as a company that has 7, 8, 9 locations and millions, if not billions of dollars of PP&E to work with. But you can compare those two different types of companies on how efficient they are by taking the rate of return on your total assets, or your ROA, as they say. And to do this, you take your net income, add back in your interest expense, and then divide by your average total assets. So for us, we had $64,000 of net income. We paid $24,000 of interest. Total those two together, and then go to your last two balance sheets, find the total assets that you reported on each of the last two balance sheets, and find the average of those two numbers by adding them together and dividing by 2. After we run all of that math through, we come up with 12.3%, which, to look at it another way, means that for every dollar of assets we own, we find a way to convert it into pre-interest 12.3 cents of net income, which is double the industry average. So now I'm going to recant on what I said before. Based upon the excellent returns that we've got going on right now, if we take out a loan to acquire more assets, we appear to be very good at making a return on what we have. We should be able to generate enough additional net income on more and more dollars worth of assets to be able to finance the loans that we had. Asset turnover ratio measures the amount of sales that you make off of your net income. So that's the same as this ratio, except now it's not bottom line profitability, it's actual terms of sales dollars that you have, but the same thing is going to apply. Take your sales revenue from the income statement, divide it by the average of the last two total assets you reported on your last two balance sheets, and you'll get a return that tells you how much you generate in sales revenue for every dollar of assets you have. We come up with $1.2 in sales revenue for every dollar of assets we have. The industry average is 3.5. So now I'm all sorts of confused. We're generating less sales than everybody else, but according to our industry here, I'm going the wrong way, we do a much better job of actually turning those sales into net income. So all these ratios work together, and you got to kind of think of the big picture from all the different ratios you have and how all of it is going to affect your books. One thing that stockholders are going to be very concerned about is how well you're using their money. When someone buys ownership of your company and gives you money, they are expecting you to have the ability to take their money and turn it into profits. So the formula to figure out your rate of return on common stockholders' equity is to take your net income, subtract out any preferred dividends you may have, because we're only looking for the portion that goes to common shareholders, and preferred shareholders get paid first, and then divide it by the average level of equity that you had during the period by taking the two numbers that you reported for stockholders' equity on the last two balance sheets and find the average of those two numbers by adding them together and dividing by 2. And here we're coming out with 18.9%. So for every dollar that we have of equity that somebody has given us, we're turning it into about 19 cents, if you will, of income. 18.9% of all the money that we've raised from equity ends up as income, even after we paid preferred shareholders income. This is way higher than the industry average, so we're doing a good job of turning our investors' equity that they're providing us into actual profits, much better than the industry. And when a company has a high rate of return on equity than assets, they say that you're usually trading on equity. It means you're making money on borrowed money, on something else. And it increases the earnings to the owners of your business, because the more and more they put in, since that's the item that you're using to turn profitability, the more profitable your company becomes. But the big one, EPS. All of the things that I've talked about so far in this chapter's PowerPoints are just things that managers would use to help make them make better decisions about the company, or compare themselves to another company, or it's something that a potential investor would use to determine if they want to invest in your company. But this one, EPS, is the only financial ratio, the only metric that you have that you actually have to display on your income statement, on one of your financial statements. When a company is publicly traded, at the bottom of their income statement, after they report their net income, they're required to also display their earnings per share. Why would that be? Well, because companies come in very different sizes. Disney has literally billions of shares out in ownership and outstanding with the public, while a much smaller company will only have maybe a couple of million shares. So if both of those companies make $1 billion during the year, Disney's got to spread that money out much thinner to each owner that they have, while somebody that gets into the smaller company that has the same $1 billion of distributable income, they can get a much larger portion. So EPS is a way for investors to decide if how much money they expect to receive in return for every share that they own. And the formula for this, it only relates to common shareholders. So take your net income, subtract out your preferred dividends, and then divide it by the weighted average number of common shares outstanding. What is that? It's on average during the year, how many shares you had out on any one given day. To find it, you would have to go through all 365 days of the year, add up how many shares you had on each one of those days, and then divide it by 365 to find the average. I'm not that cruel, so this number will be given to you in your problems, but that's how you actually find it. And for us, we see that we got $6.40. If somebody buys a share of our stock based upon our profitability, they could potentially get a dividend of $6.40 for each share they had if we chose to distribute all of our earnings and not retain anything. Now, they don't have to, but that's a ratio for later on how well you're distributing payout for your dividends. But that's what it could be. We had the ability, if we wanted to pay out $6.40 per share. Way higher than last year, almost double than last year, which is going to make our investors happy. It's probably going to drive up our stock price, but we are definitely still below the industry average, so I don't know how high it's going to drive up our stock price. And then lastly, speaking of stocks, we have a couple of ratios that can help us evaluate stocks as an investment. We're going to compare a couple of things. Firstly, how much our stock is trading in comparison to how profitable our company actually is, and how much of what we make we can actually pay out in dividends. So the PE ratio you will see listed on Every single place that you can trade stocks is one of the things on the banner that pops up as soon as you look at them, and it is the price to earnings ratio. It is a measure, if you will, of how much money you have to pay to be able to have the potential to have $1 worth of earnings distributed to you. And you take your market price for your share, where your stock is currently trading at, and you divide it by the EPS that you had calculated before. The market price for us right now is $60 at the end of 2026, way up from what it was trading for at $35 at the end of 2020. Well, we take the market price divided by our EPS, which would be calculated back here, and we come up with this year a PE ratio of 9.38, which means since we're trading at $60 per share and we have the ability to distribute $6.40 of income per each share that we had in the form of dividends, an investor could look at this as they have to pay $9.38 for the ability to get at $1 of potential earnings in distribution. This is down from where we were last year in 2025, where last year an investor would have to pay $10.29 to get at $1 of our earnings, and we're going downwards, which is not good because the industry average is way higher than us. What number is good here? Depends who you are. If you're the company, you want to be able to get as much money as humanly possible from the stocks that you issue. You want your PE ratio to be super high because it shows a willingness of investors to overpay, if you will, for your stock based in comparison to how much you actually earn during the period. If you're the investor, if you're the public buying a company's stocks, you want vice versa. You want to be able to get at those earnings as cheaply as humanly possible. So from the company perspective, you want to be the industry average. But if you're an investor looking around right here, it kind of looks like SmartTouch is a bit of a value buy that you can get. So PE ratio is, from the company's perspective, is a measure of how much revenue you can generate, how much equity you can generate from the issuance of stock based upon how profitable you actually are. Dividend yield is a measure of how much of your current market price you distribute in dividends every year. So for SmartTouch over here, we're paying a dividend of $1.20 per common share, annual dividend once a year. In 2026, it was $1 the year before. Our dividend yields on stocks are, therefore, $1.20 per share, annual dividend divided by our $60 market price, 2%. If somebody chose to buy our stock right now, they would get a return of 2% of the initial amount they had to pay in the form of their first dividend. For 2025, it was 2.9%. So we are decreasing right here, if you will, the ability of our investors to recover their initial investment in the form of dividends. Now, they're not going to care in this instance because their stock price is appreciated from $35 to $60. But going down the road, we have to talk to our board of directors, and we're going to have shareholders meetings and all of that stuff. And shareholders want you to be paying out as much dividends as possible. They'll be okay with your company retaining earnings if it gets to grow, but they want their share of the money too. And we're below the industry average right now. So there is a world that SmartTouch can exist in right here, where even though they're paying out $1.20 per share, somebody could look at it and be like, you're paying out, little over half of what everybody else is paying. Jack up our common dividends, please. We want higher dividend payments. And speaking of dividend payout ratio that we have over here, the dividend payout ratio is an actual measure of how much that could be distributed actually got distributed. We determined earlier that in 2026, SmartTouch had the ability to distribute $6.40 of distributable income to each common shareholder for each share that they had, but they didn't distribute all of it. They only distributed $1.20 of that. Well, $1.20 divided by 640 comes out to 0.19 or 19%, which means SmartTouch is distributing 19% of what they potentially could, down from 29% the year before and way below the 63% that the industry is paying. And in this case, our shareholders would definitely have a grievance that our dividend is not as high as it should be. Maybe we have a plan. We can communicate with them and tell them why we are choosing to retain such a large portion of our earnings instead of paying out dividends, and maybe they'll buy it and be happy with it, but they won't for forever. And from the investor perspective right here, if you are an income-based investor, you like getting frequent payments for what you have, SmartTouch is not looking great for us at all. We'd much rather be in this business over here that has a higher dividend payout ratio. So ratio analysis, whole bunch of different stuff that goes on. There's a formula for pretty much anything you could look for. This isn't the whole entire list of formulas that people have come up with. There's in fact literally probably over 1,000 of them. But each one has its own specific purpose. But it's not like you can take one formula and it gives you the answer about, hey, this is the key to making our company bigger. It's about running a whole bunch of different formulas at once to get the broader perspective of how your company is performing in comparison to what you've done in past years, in comparison to your primary competitors, and in comparison to the industry as a whole.